Next, let us move to this section, the acquisition method. So how we should account for business combination under acquisition method. So under AASB number 3 or IFRS number 3, the acquirer must account for each business combination by applying what is known as acquisition method. So there are 4 steps under this method. Number 1, you need to identify the acquirer. Who are the acquirer? Okay. Determine the acquisition date when it happened. Sometimes the business, for example, if you acquire shares, okay, last 2 months, you acquire maybe 40% shares. Okay, it's not strong enough to establish control. Later on, after 2 months, you add another 20%. So your shares now 60%. This is where you have gained control on that company or business. So you need to determine the acquisition date. And then recognize and measure identifiable. Identifiable means asset that you can identify. It's not goodwill other than goodwill. Goodwill is quite difficult to identify. So identifiable asset and also liability associated with this asset and the non-controlling interest. The non-controlling interest is the party or groups that controls or owns the remaining shares. For example, if you acquire 80%, this is your shares, but there are a group of shareholders that own the balance 20%. So this is the non-controlling interest. The non-controlling interest, NCI. The short form for this is NCI. The NCI. Okay. And number 4, we're going to recognize and measure goodwill. Goodwill is when your purchase consideration is greater than the fair value of identifiable net assets. Gain from a bargain purchase is when your purchase consideration is lower than the fair value of identifiable net asset. I did give you a simple example before this that you paid 120 million for a business combination with a fair value of identifiable net asset worth 110 million. So we have goodwill of 10 million. So in another example, maybe you only paid 190,000. You paid 90,000. Okay. For the identifiable net asset fair value of 110,000. So in that case, you have gain from bargain purchase. So this is your gain, 20 million gain from bargain purchase. Okay. So the acquisition method is applied on the acquisition date, which is the date the acquirer obtained control of the acquiring. When you are going to use this acquisition method, okay, that is, we need to identify the date which the acquirer obtained control on the acquiring. For example, this is you bought shares of Emirates, yeah? You bought shares of Emirates. Now you are the shareholders of Emirates, yeah? You buy 1% shares. Can you knock their door, the Emirates door, and telling them, I want my office here. Can you set up my office? I own 1% share of Emirates. Can you do that? No. You don't have control. You only have 1% shares. Many people have even more than that, but they don't have controls on Emirates. Maybe not on Emirates, other companies as well. So by having the shares, by buying the shares, does not mean you have control on that particular company. You are only entitled for dividends. If the board of directors announce dividend, so you are entitled for certain amount of dividend. That's the only your right. What if, I'm not talking about Emirates, yeah? Maybe company A, put it as company A Limited. Okay. When you acquire 1%, you don't have the control. But if you acquire 71% slowly, okay, you acquire 71%. Do you have control on that company? Yes, you have control. But it's not easy, yeah, to knock the door, go to the building, yeah, to the A Limited building tower, and and evict everyone out from the office, though you have 71%. It's not easy. You have to go through the process. For example, you call as the main shareholders, you can call for extraordinary general meeting, like EGM, like AGM, but extraordinary general meeting, and you can come up with a proposal or resolutions to remove all the directors. Yeah, during the AGM, you come up with a resolution that you want to remove all the directors and appoint new directors that you and your friends or your family members. So during the AGM, you will appoint the new board of directors. Once you appointed as the board of directors, you can appoint yourself as the CEO. As the CEO. So that is the process. Basically, you will able to appoint yourself and your groups as the board of directors since you already control 71% of the shares. And these shares come with the voting right. So in accounting perspective, when you have control, it's very subjective. You're going to discuss that in detail next semester. But I put a simple example here. When you control more than 50% shares, you have control. Yeah. Other than that, you're going to put it as a purchase of accounting for non-business combinations. Okay, step number 1 is to identify the acquirer. Okay, for sake of IFRS 3 state that each business combination, one of the combining entity shall be identified as acquirer. One of the combining entity must be identified as the acquirer, the parents. P acquire S. S is the subsidiary. Many business combinations are the result of an entity transferring purchase consideration such as cash or share or other asset or incurring liability so as to obtain control of the business. For example, when P acquire S, P need to pay certain amount of cash or give certain amount of shares or to take certain amount of liability. So that is the process. In such instances, the entity transferring the consideration, I call it consideration, or issuing the share is easily identified as acquirer. Who make the payment? Who transfer the share? So that is the acquirer. Yeah, that is the acquirer. The basis for determining the acquirer is control. That is, the acquirer is the entity that obtain control of the business. Okay. The determination of acquirer may require judgment based on analysis of the acquisition transaction. We need to analyze the transaction, acquisition analysis. So the determination of the acquirer as important step under the acquisition method as it affect the accounting for business combinations. This is my, because this will affect your accounting for business combinations. Any questions? Okay. So the first step is to identify the acquirer. Yeah. The first step is to identify the acquirer. And then number 2, you need to determine the acquisition date. When the acquirer control the acquirer. When the acquirer control the acquirer. For example, 31st December. Okay, 31st December. So that is the acquisition date. Para 8 of IFRS number 3 requires acquirer to identify the acquisition date, which is the date on which it obtained control on the acquirer. So in any transaction, yeah, relating to the business combination, we need to identify, determine when control passed to the acquirer, and thus identify the acquisition date should be quite obvious. It's very easy on that. When they sign the contract, they sign the agreement, they transfer, they make payment, so that can be used as the acquisition date. However, the following sequence of event in business combination, there are many events. The first one is the date the contract signed. Okay? The date the contract signed. A signed the contract with B. That's one date. The second one is the date of purchase consideration transferred to the entity. The payment not being made, but you already signed the contract. So next, the following week, you made the payment. Number three, the date on which assets are physically transferred from one location to another location. And number four, the date on which an offer become unconditional. What does it mean? Sometimes they put a clause there, a clause in the contract that both party, maybe both party or one side party can cancel the contract within 14 days if they not happy with the term or they have other thoughts. Maybe so that is the conditional, or maybe they have other condition that, for example, maybe financial condition, economic condition, or something, some matters that can cause the contract become void or cannot be exercised. So unconditional mean you have no right, mean both party has no right to cancel the contract. For example, give you a simple example about purchase. This is just a common purchase. There are many TV advertisements selling goods. For example, the vacuum cleaner, a simple one, vacuum cleaner, and they put a condition that you have 14 days money back guarantees without any questions. So when you purchase the items from the TV, from the advertiser, from the seller, you still have 14 days to use the assets, to try for that asset. If you're not happy with that equipment, you can return back to the seller and no question will be asked and you get your money back. Is it okay? So in that case, you have to wait until 14 days where the risk and reward transferred from the seller to the buyer, from the whole risk transferred to the seller, sorry, to the buyer. So this is what I mean by unconditional. Unconditional. Okay. Okay. So the significance of acquisition date relates to the fact that it determines what fair value are applied to the measurement of the following component of the business combination. Number one is the identifiable asset and liability acquired, measurement of the fair value of consideration transferred, and measurement of the non-controlling interest in the acquisition. For example, first we are looking at the asset and liability, what are the amount, and then we're looking at the fair value of the consideration transfer. This is how much you pay. This is how much you pay. Maybe in terms of cash, in terms of shares, cash, paid, shares, issues. Okay, what is the amount? And then from this, we also check the non-controlling interest. For example, if you acquire 80% of the shares of B, so the non-controlling interest will be 20%. So the asset that you acquire is not 100%, it's only 80%. So you need to determine the non-controlling interest. What is non-controlling interest? If you buy 80% shares of company B, so the remaining 20% owned by another third party. We call it as non-controlling interest. So the following component is the measurement of any previous held equity interest in acquiring. But sometimes we have this piecemeal acquisition. You acquire 20%, then acquire another 20%, and then acquire 30%. So previously you already acquired 20% and 20%, 40%. So determine the acquisition date will also impact the acquisition subsequent earnings of the combined entity. So these are the important elements. Number 3 is you're going to recognize and measure identifiable. What do you mean identify? Asset that you can identify. Okay. And liability assumed. Para 10 of AASB number 3 state that as of the acquisition date, the acquirer shall recognize separately from goodwill, the identifiable asset acquired, the liability assumed, and any non-controlling interest in the acquirer. So you have to identify the assets. And so recognition of an identifiable asset acquired and liability assumed is subject to condition under paragraph 11 and 12. Okay. So what are the measurements that we are going to use for identifiable asset? We're going to use the fair value, yeah, not the carried amount, not the book value. We're going to use the fair value, the closest value at the market, So in that case, all the asset and liability must be measured using fair value at their acquisition date. So what is the fair value? Fair value is an exit price, being the price that would be received to sell an asset or paid to transfer liability. If you have a car, what's the fair value of that car? It's very easy. You go to do Beazle, you can check the price, same model, same price, what is the amount of money, you're going to receive if you sell the car right now. So you have, it's not 100% accurate, I can say, but at least you have some range between 100 to 105,000. So that is the fair value. Okay, between the market participant at the measurement date. So that is fair value. So consideration transferred is number 4. Consideration transferred is the payment made or the share issued to the acquiree. So consideration transferred refer to what the acquirer give up, what we give up. Yeah, maybe we give share, we give cash to acquire the net assets of the acquiree. So according to para 37 of AASB number 3, the measurement is made at the acquisition date and consists of the sum of the fair value of everything transferred by the acquirer to the former owners of the acquiree. It can be in terms of the fair value of the asset acquired, transferred. You have cash, you transfer that cash to the acquiree. What is the amount of that cash, the fair value? When it comes to cash, the fair value is equal to the carrying amount. Whatever notes there, 100 dirham, so the value is 100 dirham. Number 2 is the fair value of liability incurred. You don't pay them cash, but you take responsible of all the liability. So that is also considered as purchase consideration. And number 3 is the fair value of equity interest issued by the acquirer to the acquirer. You give shares to the acquiree. So that will be also considered as the consideration transfer. Number 1 is the fair value of asset. Maybe you give your land to her, to A. Maybe at the PPE, maybe cash. So this is asset transfer. A transferred to B the land, PPE and cash. Maybe A also take all the transfer, B transfer all the liability, B give all the liability to A. Now A assume have to take over all the liability. Or A give shares to B. So this is 1, 2, 3 ways to determine 3 components of consideration transfer. Okay. The most common is cash. The fair value of cash or cash equivalent is normally readily determinable. So the entity incremental borrowing rate would be the discount rate normally applied to any deferred payment. If you are going to pay cash, maybe in the future, deferred payment, this is year 1, 2022, 2023, 2024. So you're going to have paid them 10 million, 10 million, 10 million. So you need to use your present value. I think you learned this during your statistic or maths class. You have to use the present value of PVIFA to determine what is the present value. So this will be the fair value of deferred payment. Fair value of deferred payment, yeah? Deferred payments. If the payment made here 30,000, so it should 30 million is much easier, yeah? So this is for deferred payment. Next is consideration transferred using non-monetary assets such as property, plant and equipment, investment, a license, and patents. Okay, so this is a simple way as well, common way. Paying by giving up your assets, your non-monetary assets. Number 3 is equity instrument, where transfer cost of an equity, yeah, shall be accounted as for deduction from equity rather than expense. This is the, if you are talking about the transaction cost, that one will go as part of the equity rather than expense, if there is any transfer of equity. Liability, cost of arranging or issuing debt instrument are integral part of the liability issue and are included in the initial measurement for liability consistent with the accounting for cost of issuing instrument. So this is about liability. Okay. Any cost relates to issuance of liability. Next is contingent consideration, whereby the Appendix A provide this definition. Usually, an obligation of the acquirer to transfer additional asset or equity interest to the former owner acquirer as part of the exchange for control of equity if specified future event or condition are met. They put some condition there. So in case, for example, the company is making profit, so you have to transfer additional 20 million. So that is conditional, contingent, yeah, contingent. Or in case so these are the contingent, yeah, so many acquisitions process there. Okay. So the next one is acquisition related costs related to acquisition. For example, for PPE, directly attributable costs are capitalized into the cost of acquisition. It's very easy. However, acquisition-related costs incurred in business combination are considered as expense. For PPE, you could put it as asset. For any cost relates to the business combination, this will go as expense. You go to income statement rather than balance sheet.